Everyone thinks the 2008 financial crisis happened because people couldn't pay their mortgages. That's cute, but it's also completely wrong. This disaster didn't just happen, it was engineered. And the truth is way uglier than you've been told. And yes, it gets worse. Imagine waking up in a world where money suddenly stops making sense. Banks are collapsing faster than people can refresh the news. ATMs feel less trustworthy. Retirement accounts look like bad jokes. Money was evaporating like it had a personal vendetta against humanity. Even economists were panicking, which is rare because they're usually confused, not scared. Here's the official explanation you've heard 1,000 times. They gave mortgages to people who couldn't afford them. Homeowners were reckless. Too many risky loans. And sure, that sounds logical, but that story is like blaming a plane crash on the passenger seatbelts. It ignores who built the plane, who sold the tickets, and who knew the engine was on fire. Because here's the part they never mention. The real problem wasn't bad mortgages, it was what banks did with them. Wall Street figured out a trick. Take risky home loans, bundle them together, slap a shiny label on them, and sell them as safe investments. These were called mortgage-backed securities, and somehow, magically, trash was being sold as treasure. Banks told investors, "Don't worry, housing never goes down." That was the sales pitch. That was the lie. It was like watching someone juggle knives while yelling, "Trust me, I've done this before." But the craziest part is still coming. Because the system didn't just allow this behavior, it rewarded it. Here's how everything spiraled out of control. Greed turned into bonuses. Bonuses turned into pressure. Pressure turned into denial. Warnings were ignored. Risk models were adjusted. Common sense was politely escorted out of the building. Banks bet on housing prices forever going up. Investors copied each other. Rating agencies rubber-stamped nonsense. Everyone made money until they didn't. And when homeowners started defaulting, the entire chain reaction detonated. Some experts still argue it wasn't a crisis. It was a robbery wearing a crisis costume. September 2008. This is when the music stopped. Markets froze, trust evaporated, and banks stopped lending, even to each other. When Lehman Brothers collapsed, it wasn't just a bankruptcy. It was a signal flare. If they could fail, anyone could. If money could scream, this is the moment it would have lost its voice. But here's the detail everyone ignores. And it still affects you today. People think the crisis ended in 2009. It didn't. Governments printed money at historic levels. Interest rates were slammed to near zero. And asset prices were artificially inflated. The result? Housing became unaffordable. Wealth inequality exploded. Savings earned nothing. Your cost of living today, your rent, your debt, why does everything feel rigged? Yeah, thank decisions made back then. Even institutions like the Federal Reserve rewrote the rulebook not to fix the system, but to keep it alive. Here's the part that makes people uncomfortable. Almost no one at the top faced consequences. The system wasn't punished, it was bailed out. Banks were deemed too big to fail, which is a polite way of saying too powerful to touch. Taxpayers absorbed the damage, executives kept the bonuses, and the machine rolled on. It sent a message louder than any headline. If you're big enough, rules are optional. The 2008 financial crisis wasn't about math, it was about human behavior dressed in a suit. Greed wins the short game, fear destroys the long one. And every crisis teaches the same lesson. The system doesn't break accidentally, it breaks predictably. And if you think this story is insane, wait until you see what happened after the bailout. The domino effect, when everything connected. Here's where the story turns terrifying. Those mortgages weren't isolated. They were connected to everything. Pension funds, retirement accounts, universities, foreign governments. People who never bought a house were still betting on the housing market without knowing it. When one piece failed, everything started to fall. This wasn't a crash. It was a synchronized collapse. And no one could tell who was bankrupt and who was just pretending to be stable. Markets don't collapse because of numbers. They collapsed because of fear. Banks stopped trusting each other, and that's when the system froze. Think about it like this. Banks lend money to each other every single day. But in 2008, every bank started asking, what if they're next? So they stopped lending. And when credit dies, the economy goes into a coma. Businesses can't operate. People lose jobs. Companies shut down. Not because there's no work, but because trust disappeared. This is the most controversial part. Government said, if we let the banks fail, the entire system collapses. So they did the unthinkable. They rescued the same institutions that caused the disaster. Hundreds of billions, trillions in some cases, public money, while millions lost homes, jobs, and savings. The banks were saved, not because they were innocent, but because they were essential. That day revealed a brutal truth. The system isn't fair. It's functional for those in power. This is the question everyone asks. How did nobody pay for this? The answer is simple and disturbing. Because the rules were written by the same people who benefited. The decisions were legal. The damage was real. The crime wasn't illegal. The consequences were massive. And the message was clear. If you're small, mistakes destroy you. If you're big, mistakes get absorbed by society. The crisis never truly ended. It just changed form. After 2008, asset prices exploded, inequality widened, living costs surged, housing became unreachable. People feel like they work more for less security. That feeling isn't imaginary. It's the long shadow of that collapse. The bill was never paid. It was delayed. The 2008 financial crisis wasn't an accident. It was a warning. The financial system doesn't exist to protect people. It exists to protect itself. And as long as we believe this was a one-time event, the next collapse won't be shocking. It will be familiar. Here's something important. The crisis didn't happen because people were stupid. It happened because the system felt safe. Ratings agencies labeled toxic assets as AAA. Banks said risk was diversified. Models said worst-case scenarios were impossible. Everything looked professional. Everything looked controlled. That's the most dangerous moment in finance. When risk wears a suit, people stop questioning it. And the more official it looks, the less people ask questions. Wall Street didn't just sell risk, they hid it. They created products so complex that even the people selling them didn't fully understand them. Layers on top of layers, derivatives on derivatives. Confusion became a feature, not a flaw. Because when no one understands the product, no one knows who's responsible. And when responsibility disappears, so does accountability. Charts recovered. People didn't. Families lost homes they spent decades paying for. Careers ended overnight. Entire communities collapsed quietly. This wasn't just a market event. It was a psychological shock. People stopped trusting banks, stopped trusting institutions, stopped trusting the future. That kind of damage doesn't show up on graphs, but it stays with generations. After the collapse, the message was simple. We fixed it. New rules were announced, new regulations were promised, but the core incentives, they stayed the same. Risk is still rewarded. Losses are still socialized. Size still protects power. The system didn't change. It adapted, and adapted systems are harder to spot and harder to stop. This isn't history. It's a pattern. Low interest rates, asset bubbles, record debt. Sound familiar? The conditions that led to 2008 didn't disappear. They evolved. That's why every major financial shock since then has been bigger, faster, and harder to control. We didn't eliminate the risk. We postponed it. The 2008 financial crisis wasn't the end. It was a rehearsal, a test of how far the system could bend without breaking. And now we know the answer. Very far. The question isn't if it happens again. It's who pays next time. And in the next video, we're exposing the system that replaced housing as the engine of speculation, and why it might be even more dangerous.